goodness, that reeks. The market breath on Friday was just absolutely horrific. Makes for a tempting short up here at the all-time highs, don't get me wrong. But sellers, do not overstay your welcome. We've got the Fed, major earnings, and the labor report all in the rearview mirror, and this week the big fundamental driver will be the 10 and 30-year bond auction, so let's build a game plan based on logic to navigate the next couple of days. As always, check out the links listed down below in the description. The first one down there is our 2024 Macro Themes Outlook Report for the folks who missed it on Wednesday. Hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY monthly time frame, now that January bars have officially closed out, what do we see in terms of candle structure and location? Second one in is January. Solid green-bodied bar with maybe a little bit more upper wick than we'd prefer to see, but definitely reasonable. Moving into blue sky territories, a little bit of skepticism up there. We've still closed in the upper third of the monthly range, and the lower wick would suggest that buyers stepped up near the lows, pushing prices to the opening print and through the opening print again for a close in the upper third of the range here. So buyers are in control structurally. If we think about location on the bar-to-bar count, high or low, as well as a higher high. And I would also point out that we did close January at a new all-time high. So 2 for 2 on the monthly count. If we're thinking about monthly trend, it's definitely up. We have lows, higher lows, along the way highs, higher highs, and higher highs. We're no longer really having a threat for a double top at the previous all-time high because we've moved through it, of course, but it's definitely reasonable coming from the highest high in the trend sequence, which has been 1, 2, 3, and now almost 4. It's very early in February, obviously, but 4 months in a row green. It's definitely reasonable that a higher low pullback could be on the table, and because we're coming from the highest high, we know that it's very reasonable that the uptrend will remain intact. So any pullbacks on the monthly that could potentially find a higher low here around 459, 460 makes a lot of sense. Not only structurally prior resistance now acting as newfound support, but as we know, and we've talked about this on the weekly, coming in with a Fibonacci from the low of October of 2023 to the all-time high, your 38.2 is going to offer confluence around that zone. The anchored VWAP from the October low, as we'll see on the weekly, is also confluence around that level as well. 460, 459 makes a lot of sense for a monthly higher low. Another perspective to at least consider here is coming in from the low of 2022, which coincidentally was also October, up to the all-time high, and just recognizing that our 61.8 is now confluence with this major zone on the monthly, right? Prior support then acted as resistance, and this was the whole premise of the monthly inverted head and shoulders break, retest for a higher low in October of 2023, of course. That's a line in the sand. This is a major monthly line in the sand. So pulling back from the highest high in the sequence, yeah, it'd be great to find a higher low here, but everybody's talking about, oh, with this hawkish Fed, maybe we're in for a deep, dark, dirty recession with no rate cuts on the horizon. The market's going to price it in all wrong. We need to correct price aggressively, right? Just keep in your back pocket on the higher timeframes like the monthly. Nothing really changes unless you break down underneath 405, 410 as a little bit of a zone. Your monthly 50 SMA in blue will slowly provide confluence there. Yeah, if we get underneath this level, larger issues start to appear in the market. And maybe this is actually a higher high double top, right? If we just scrunch this chart out, maybe it looks something like this. Higher high was a fake out, and then we move back down to the neckline. Yeah, sure, we'll concede when and if we get there, but it's just not even a conversation for anything other than a monthly time frame. If you're a trader intraday, this should not even be a thought, right? But as we're providing context for the current market move, so far, we're in the green with the buyers remaining in the driver's seat on the higher time frames. The next thing to talk about is projected targets. If this is a massive monthly bull flag and we've broken out of that flag with a higher low outside of the flag range, then let's take a measured move approach and see what that might suggest. Coming in from the low up to the high to the base of the flag consolidation, we're talking about a huge target at 611. And again, the idea is not that we go here tomorrow, next week, next month, even this year, but over time, the projection of this flag is for some serious upside. Something a little bit more reasonable within striking distance would be the cup and handle that we've been talking about from here to here back to the pullback low. And we know that this measured move, we've talked about it on the weekly charts, right? Closer to 520, 518, as you can see. And again, not this month, not next month, but maybe at some point this year, it starts to become a contender. The one thing I would start offering as confluence is your 61.8 from the major bull flag that we just discussed here is very similar to that move from the cup and handle, which is this look right here on the monthly time frame, right? We've broken that. We've cleared the top of the cup. Any higher lows above keep the trend intact. This area is very interesting from a measured move perspective. Again, loosely between 510 and 520. On the weekly time frame chart, you can start to see how the candle structure is actually even more bullish than the monthly. It's hammer-esque in nature, implying that in the lower wick, buyers stepped up and were able to move to the opening print and through the opening print for range expansion, primarily due to the earnings gap and go on Friday. But regardless, the buyers closed at a new all-time high towards the upper edge of the weekly range here. So structurally, buyers get the win. If we think about location on the bar over bar count, equal low and a much more meaningful higher high. So 2 for 2, buyers in control. The trend is most certainly up with a new higher high being produced. And quick caveat from a risk management perspective, yeah, it can be fairly difficult to interact with markets at new all-time highs, buying the highest high in the trend sequence. You don't really have a clear place to put your stop. So higher lows are welcome, and we know that they would not jeopardize the weekly trend at this point in time because of the highest high that was just produced. And the main place to look for a weekly higher low right now is the top of this previous range over here, roughly around 480 on the weekly. On the daily chart, we know the level to be closer to 477.50. If there is something that looks like this, we are still maintaining a weekly uptrend. And as we saw from the monthly time frame chart, this level around 460 still makes a whole lot of sense on the higher time frames, coming in with our Fibonacci's, your 38.2, and as we were not able to illustrate on the monthly, let's do the anchored VWAPs as well. This is actually much more cleanly aligned with currently the previous structural top, 459, 460, anchored VWAP from the October low. As we zoom out on this chart, let's just quickly throw on a volume profile here as well, and we'll just go auto zoom. Here we go. We remember that the previous all-time high is the top of the weekly balance that we were just referring to, closer to the 480 level. So the main name of the game is that higher low pullbacks are welcome, and we're trying to trade in the direction of the prevailing winds, which are certainly in the upward direction to achieve, hopefully over time, those 510 to 520-ish target zones. The last caveat on the weekly is that the lower wick of last week's bar may just be the only pullback that we're getting. We might not get anything more substantial than that. So unless the daily trend, unless the hourly trends really start to shift substantially, that might be it. We may continue here in the upward direction. On the daily time frame chart, let's first evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 501.21, implying a higher high, new all-time high as well. And if we're contained by the lower bound, the number's at 487.48, implying a higher low. So expected move does strike me as being more bullish than bearish here. The trend on the daily time frame remains in the upward direction with lows, higher lows, and firm higher lows have finally been found. We certainly flipped into an hourly downtrend here, so this now acts as your last higher low in the trend sequence. Of course, along the way, highs, higher highs, higher highs, higher highs on the Friday session, meaning that we can afford a pullback to search for another higher low. So we flip into an hourly downtrend. Can we find buyers on the retest of 491.50? That would be the first top of mind watch over here prior to equal highs. Can it now act as support? So 491.50, and we will still also maintain a daily uptrend if we find buyers on a deeper pullback to retest these three equal highs, 1, 2, and 3. Also, the opening print of basically Jerome Powell's infamous day there now on Wednesday at 488.25. If we can find buyers near that, that would also be the lower edge of this week's expected move. Great confluence from that point of view, and we maintain a daily uptrend. So pullbacks are welcome. Those are the first two key areas I would start thinking about, 491.50 and 488.25. We'll update you on Wednesday if we start coming down into these equal lows, because this is where the danger starts to arise. It would not be clean to fall underneath 488.25, but you could at least understand how there's still an opportunity for a higher low, very nuanced one, away from this 482.85. However, if we do see a stronger breakdown, the place where the bears finally say like, aha, we got you a little bit here, is on an equal low reattempt to this really poor structure. It's two equal lows from this Monday and Tuesday balance, and Jerome Powell's breakdown went right to that level very, very precisely, right? So 482.85, if tested again, should break down. There's got to be a lot of stops that are stacked underneath it, and we're looking for an excess low to be put in, not a lack of material excess, right? This is very, very precise, improper end of the auction. We'll talk more about that on the market profile in just a moment. And what's the idea, right? If the daily trend is going to break to the downside, and this is all going to come from a lack of hold, let's just call it, around 488.25. So this, good to go rock and roll upward direction. This, good to go rock and roll in the upward direction. Say we break down underneath and we start consolidating down here, the threat on the daily chart at least is for a stronger breakdown underneath 482.85 to achieve your weekly pullback to 477.50, the top of the previous range here. Resistance here. Can it act as newfound support? And if it takes the proper duration of time, it's very, very speculative right now, but if it takes the proper duration of time, will we get confluence with our daily 50 SMA? It's usually a very classic place for a pullback to be bought from major institutions. So watching that closely, can a daily breakdown here lead to a weekly higher low at 477.50? But let's just rewind the clock here a little bit. Does anything about this structure on Friday, solid green bodied bar, suggest that there is anything, strong to the downside? Not really. And again, we'll get to market breadth and how it was not great on Friday, but pullbacks should be welcome because all of the other indications outside of breadth would suggest that risk on is still the sentiment, the distribution of sectors is still bullish. We'll get to all of this stuff, but higher lows trading in the direction of the higher time frame trends is the name of the game as long as we're above. Daily line in the sand, 488.25. Weekly line in the sand now, 477.50. On the hourly time frame chart, it's all about the Wednesday and Thursday interaction because it continues to prove that there are absolutely no stronger sellers entering this market. On Wednesday, we know it's the Jerome Powell FOMC speech. There's the high, there's the waterfall to the downside. Sell side momentum is a factor. There is increasing volume as that breakdown is taking place. So, okay, Thursday opens up and we open relatively weak at the bottom end of that breakdown range. Notice that Thursday morning, we got an opening range here where the first couple of hourly bars are fairly overlapping, but notice the second hourly bar makes a new low of day, and sellers do not capitalize on that intraday momentum. We do not test this low. It's up, and away. The second place on Thursday where sellers may have built an edge was in this inverted hammer about midday, trying to reject the high, the same high that the Jerome Powell FOMC debacle rejected as well, 488.25. And what happened into the end of day Thursday? Obviously, we closed back above that level here. You could even start to think about this little interaction as a very micro inverted head and shoulders on maybe something like a 15-minute time frame chart. But for the most part, as we continue away from that neckline here, as we recapture this area where again, there was no stronger sell side reaction other than a little bit of a first test rejection and then break into the end of day, with the big recapture on Friday, it's up, and away. The trend remains in the upward direction. And again, as we think about the participants over here, none of them are stronger sellers, even on the heels of Jerome Powell momentum. So as we walk forward into the coming weeks worth of trade, it's very simple. If we are underneath 494.50, expect a little bit of a pullback, some give back because the breadth was so bad. But it's not enough to change the trend. We're still looking for that daily higher low as discussed around 491.50. So hourly double bottoms, 15-minute double bottoms, inverted head and shoulders, simple hammer candles, right? The whole 9 yards we always discuss. That's pullback level number one. Pullback level number two, as we described on the daily time frame chart, is down here. Same outcomes, looking for 488.25. So we know where the buyers can potentially step up, but let's at least consider where we might run into some trouble from the sellers if stronger sellers are going to emerge. So let's say we get the first pullback here and then we start to struggle. All right, we struggle and we start balancing. What does this turn into? Certainly a little bit of a double top risk here, where a stronger move underneath 491.50. Shorts could be on the table because you're changing the hourly trend for the daily pullback into 488.25. All right, let's say that that does not happen and it's a straight shot here and we start to move higher. If we do something like this, possibility for a lower high, and then we're concerned for a deeper move back down underneath that 488.25 lower edge of the weekly expected move. So that's where the bears start to build an edge. Very speculative right now because we know that on all of the higher time frames and even here on the hourly chart, there is no stronger evidence of stronger sellers stepping into this market trying to push price in the downward direction. What about confluence? If we come in with the Fibonacci's on this hourly move here, very close, 38.2 confluence with 491.50, 61.8, always a Fibonacci line in the sand, almost perfect confluence with 488.25. So reinforcing those levels. And let's lastly take a look at our intraday anchored view apps. You can see the cluster is currently sitting at 488.25. This one, and by the way, these are anchored too. Let me just give you the rundown. The gap up from Wednesday of 2 weeks ago, the Monday breakout of last week, Wednesday's open before Jerome Powell's breakdown, and then Thursday's open as well, which kind of marks a pseudo bottom from that breakdown, right? So all of this confluence, 488.25. The Thursday volume weighted average price is slowly going to creep up for confluence earlier in the week with 491.50. But for the most part, this reinforces the ideas that so far we're looking to be pullback players. If the market does consolidate over 494.50, again, it's very difficult from a risk management perspective entering the market up here. But if we get tight consolidation for like a Monday opening range, maybe there's an opening range break, put a stop here, and then look for upside because as we know, slipping underneath this, because it was a breakout level into the end of day, right? If we're under underneath, it wouldn't be unreasonable for that pullback here. Again, considering that the market was really only driven by a handful of the Magnificent Seven for the majority of the Friday gain, right? So more open to the idea of pullback because of that. But if we do get the consolidation, we know 500 is probably the psychological level that the market may try to tag. You're also going to want to watch the SPX at 5,000. That's going to be the talk of the town. Market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner, and we only have to ask ourselves one question. Do the Friday internals align with the Friday price action? And the answer should be a glaring no. Huge exchange level divergence, speaking directly to concentration risk in things like your Apple, your Google, even Amazon, NVIDIA, Meta. I would argue that Microsoft is in that cohort as well. Less interested in Tesla these days, as we know, falling from grace there. But for the most part, look at the volume flows on Friday. Outflows from the market. Net flows on the week, negative 135 million. The advanced decliner opening in trend lower zone. Yes, it does flip into an uptrend, but it can hardly close above negative 1,000 on Friday. Cumulative build out of the tick down below. Flat to negative 885 into the close. We know that substantial reads, if we're looking for something positive, should be 5,000. Substantial downside would be negative 5,000. We saw a substantial breakout from price. Why was the exchange level data not participating? Again, the answer is concentration risk in some of our Magnificent Seven stocks over on the core list of companies. As we look back just one day, though, let's just compare and contrast, right? Certainly on the Wednesday breakdown from Jerome Powell, strong outflows from the market, getting close to trend lower zone here, cumulative build in the downward direction. Do the sellers maintain their edge on Thursday? Thursday is really the more important breakout day, in my opinion, for all the reasons we just discussed on the hourly time frame examination. You can see strong volume inflows. The advanced decliner actually closes near trend higher zone, and the cumulative build on Thursday was solid as well. Not 5,000, but 4,400, right? So pretty darn close there. So we don't want to unwind all of Thursday's activity. That speaks to the flip-flopping of gifts, if you will, from the sellers having the edge to the buyers having the edge, but definitely skeptical of what we saw on the Friday price action based on what was happening here at the exchange level. Quick update on the internals. We have added the S&P 500 to the breadth script. We've added it to the cumulative volume, and we've added it to the cumulative tick. If you've already purchased these indicators here and here, just reinstall based on the updated script from the website. You do not need to repurchase. If you're trying to use the one-click install links, ever since the transition to Schwab, you have to click on the setup icon, top right-hand corner of Thinkorswim, go into the open shared item dialog right here, and paste the script, or it's really a URL, in this box, and then you will be good to go. You do not have to use the full script, taking the code itself and pasting it into a new indicator, but the one-click install via the web redirect is not working since the transition to Schwab. So with that said, let's move along to the market profile. So here it is, as always, being Exhibit B. If you're not familiar with the market profile, check out the video tutorial in the top right-hand corner. 3 big takeaways on the market profile. Number 1 is that we have a poor high on the Friday session in need of repair. We do not have any excess at that high. Number 2 is that the value area low from the Friday session is mechanical at the prior top number 1 and prior top number 2. The level in the ES futures is 49.55, and that's the equivalent of 491.50 on the SPY cash that we were just looking at. Point number 3, last but not least, is that on the Thursday session, even though we had bullish internals, the value area and point of control are lower in that individual session. So what's the takeaway here? If these folks are going to turn into overhead supply, and keep in mind, this is when the buyers were getting active. We saw that on the internals just one screen ago. If we're going to turn them into overhead supply, it requires a breakdown of Thursday's low. Any sort of pullback to not only retest this level up here, which is confluence with the value area low from Friday, but even a retest of this area in here, which is the equivalent of 488.25 on the SPY cash. In the ES futures, it's 49.30. These pullbacks do not turn the Thursday buyers into overhead supply. It would be much more dangerous if on the Thursday session, the value area and point of control was something like up here and the point of control was like that, because structurally you could still go to that 49.30, but if it was taking out the point of control and starting to dip a toe into the value area, it's much easier to turn these folks into overhead supply. Not the case with what was printed during last week's session. Changing gears to the QQQ monthly time frame chart, what do we see here from a candle structure and location point of view? Unlike the S&P, this is much more of an indecisive doji where the upper wick is about a full third of the candle range. Same thing with the body, same thing with the lower wick. Maybe a small edge to the buyers, simply noting that we have ourselves a green body, meaning that the open is underneath the closing print here. I would really argue that the upper wick is an unfortunate cause of timing, to be honest with you, right? A lot of uncertainty around the FOMC, which was pushed directly into the end of the month. The month closes out based on timing, and we're already higher into the early stages of February, basically at an equal high to the January high. So I wouldn't look at the upper wick and say, oh my goodness, all of a sudden these stronger sellers are getting active in the NASDAQ. It's not the case. If we look at the location of the bar, it's much more easy to understand where on the bar over bar count, we have ourselves a higher low as well as a higher high. And the monthly did technically close outside of the December range and certainly above the previous all-time high. And again, in February, we're basically at an equal high already, suggesting a possible higher high on next month's close. So for the most part, location is bullish. Structure, it's unfortunately a bit more neutral because of that upper wick, but again, it's a timing issue. If we think about trend here, we have lows, soft higher lows, firm higher lows, highs, soft higher highs, firm higher highs, and all-time highs, pulling back from a higher high. The all-time high in the trend sequence means we can afford a higher low somewhere around 380 that would be respectful of previous structure. Let's check in from a Fibonacci point of view, coming in from the October 2022 low to the all-time high. The 38.2 is underneath that prior structure at 385, so all good. If the monthly pullback looks like this, we're definitely in healthy consolidation territory over the 38.2. The 61.8 is confluence with a key monthly level here, prior support, then acted as resistance. It's not so much of an inverted head and shoulders. It might be there, but the right shoulder is really lacking. Notice that that level is confluence with our monthly 50 SMA, roughly around 320s at this point in time. It'll continue, obviously, to creep in the upward direction, so you're going to lose the confluence, but the idea is, unless there's a large breakdown underneath this level, it's very difficult to say very bearish things about the QQQ monthly. If we zoom out, I'm really more interested in seeing what the projections are to the upside from the sickness low to the previous all-time high to the pullback low. And keep in mind that this is not as strong of a bull flag indication compared to the S&P monthly time frame chart. Reason being is that it required a full test of the 61.8, whereas the S&P found support over the 38.2, right? If we just clear that up, though, you'll still see that the projection is quite large. We're talking about 500 on the NASDAQ, and you're like, okay, well, check in on the cup and handle. That's got to be more reasonable. Not quite. It's way up there, right? We're talking about 475, as you'll see, coming to the top of the cup, the pullback low. Yeah, 477, 475. Still, the idea on the higher time frames is that the trend remains up and there is some room to run in the upward direction. Let's clear that up and move on down to a weekly time frame chart. Just like the S&P, we have ourselves more of a hammer-esque style bar on the weekly time frame, but the lower wick location is far more important here on the QQQ. It actually violated the previous weekly low, and the previous weekly structure was an inverted hammer, suggesting that, yeah, okay, maybe there were some sellers up here near that high. The sellers could have materialized on momentum underneath the weekly low to rotate through some of the thin structure. We'll see this on the daily and achieve the deeper pullback to here. It simply did not take place. So the fact that we broke the low, found a lower low on the bar-to-bar count, but then closed at an equal high with a hammer-esque style structure strikes me as no, we do not have stronger sellers entering the market, and instead the buyers remain firmly in the driver's seat in the NASDAQ. The stronger pullback level, though, would be the retest of the top of the range. As we know, 410.25, we'll see it on the daily in just a moment. Let's see if we're getting any confluence here from a Fibonacci point of view from the October 2023 low to the all-time high. 38.2 is now confluence with the bottom end of this range, just meaning that this pullback certainly would be healthy and constructive on the weekly time frame. It would be coming from a highest high in the sequence, so a higher low could be achieved at that level. Again, 410.25 here. Let's check in with our anchored view apps and see what these are offering on the QQQ. Not much confluence with the 38.2 fib that we were just looking at here, not really in play for the coming weeks worth of trade, and volume profile last but certainly not least on the higher time frame. You're just getting sort of a midpoint there around 400, previous all-time high, volume shelf if you will, not really suggestive of anything strong from the profile here. Let's move along to the daily. Beginning with the expected move, you can see that the upper bound is going to be at 436.94, implying a higher high. If we're contained by the lower bound, it's 421.09, implying a higher low, and that of course is a bullish expected move to continue the trend in the upward direction here. But the issue with the trend is that it's different technically from the S&P. We're still in an uptrend with lows, higher lows, higher lows, but notice that we have highs, higher highs, higher highs, and only an equal high on the Friday session. Now, let's not get it twisted. Of course, that's a great first step for continuing the trend, but the issue, the red flag, is that we've already discussed the concentration risk in the Magnificent Seven. If they're going to cool off on the Monday, Tuesday sessions, perhaps, we don't really want to look for an aggressive higher low in the QQQ, and instead, we really need to build out continued consolidation in this overall range. You do not want to fall underneath 423.50 as we're consolidating near this equal high. If we were to get consolidation up here, great. Possibly a 3-bar play breaking out into the Tuesday session, maybe a double inside bar for a Wednesday breakout. That would all be fine and dandy if the Magnificent Seven cool off and then continue into maybe the second half of the week. If they just start ripping out of the gates on Monday and Tuesday, fine, we'll look for that follow through. But if there's weakness in your Apple, Microsoft, Google, Amazon, NVIDIA, Meta, if those stocks are weak on the Monday session, I would be very cautious about being aggressive for an equal high break up and over 429.15. Let's say that you're getting weakness in the Magnificent Seven, but the market breaks out anyways. Very cautious of that breakout, not trying to buy the equal high break, and instead being very patient for the retest higher low over 429.15. That way we can manage our risk, right? We put a stop just underneath, look for the buyers to step up and trade it into blue sky territories. That to me is much more responsible here for the next phase of potential range expansion in the upward direction. Now, sellers, you have something going on here, and it's the possibility of a double top. But please, just because I'm mentioning it here, let's not jump the gun. What does a double top require? It means breaking down underneath the neckline and ushering in some sort of lower low. A good first step for the sellers early this week, or perhaps by the midpoint of the week, would be getting price acceptance under 423.50. If we can unwind all of Friday's move and start to accept underneath, that would be concerning because now this is overhead supply. Friday is a bit of a failed break out of this as a 2-bar range because remember, Thursday was an inside bar, right? So under 423.50 is where your issues start to arise on the daily chart for a reversal back in the downward direction. Now, do we have evidence of stronger sellers or do we have evidence of stronger buyers? Let's think about this because this is different than the S&P. In the NASDAQ, on Wednesday's breakdown, we already moved into and through some of the thin structure from this breakout before the 2 bars of consolidation here, whereas the S&P made an equal low at these lows. And you can clearly see that we're already back higher. The sellers, in theory, should have had no issue rotating through thin structure to retest prior resistance, and close the gap down here. Did that happen? The answer is absolutely not. So I would be hard-pressed to say that the bears have an overwhelming edge on the daily time frame. And to me, it would be more likely that we either see some sort of weak continuation or consolidation in this range, looking for the setup into the later half of this week. Let's move along to the hourly time frame chart and get even more granular with the price action. All of the same sentiments still apply to what we discussed on the Thursday giveaways as the S&P, right? You can see the thin structure back here, not much to really go on. A retest of this would have been much stronger for the sellers, right? It did not happen. Here's your sort of very short-term inverted head and shoulders over the neckline. Notice on Friday, we gap into and stay inside of the upper range, right? Very little bit of a gap fill, reversal, and obviously we're back higher. So do not overcomplicate it on the hourly time frame chart. Any higher lows here that then break out, great. Any higher lows here that then recapture and high, like great. These are all pullbacks that we're looking to participate in. Here you can see your inverted head and shoulders, pie in the sky sort of version, right? Larger issues start to arise when and if this turns into a double top. We find ourselves underneath the neckline, trading down here below that 423.50 we just discussed on the daily time frame, because now you have a double top equal high, right? There was no higher high that you're pulling back from. As soon as you start moving underneath this 418.25, the floodgates should open up for at least 412.75, if not lower, based on the premise of, okay, you had great earnings, everything was aligned with the bulls. What happened, right? It has to raise some red flags. What happened if we can't get continuation here? Let's take a look through the lens of the Fibonacci from the low of Wednesday up to the Friday high. Not great confluence with the 38.2, but just, in terms of thinking along the lines of where healthy bull flag consolidation can take place, obviously a hold of your 426.25 would be over the 38.2. So that by itself is bullish in nature. Your 61.8 is underneath the 423.50, and that strikes me as a bit of an issue. So could you technically find buyers around this level? Yes, but it's my belief that this would turn into too heavy of overhead supply. You've already sort of failed if you're underneath. This would not really, in my eyes, offer the strongest higher low. 421.25, 421.09 as the lower edge of the weekly expected move. I think too much damage has been done, and then, this runs its course and we're lower from there, triggering the daily double top perhaps. But again, this is a back pocket situation based on the failure from the sellers on the Thursday session, that psychology that we've already walked through. Let's take a look through the lens of the intraday anchored view app, really providing confluence around that 423.50. So all good from that point of view. I would say that this supports the thesis that we're still on the buy side as long as we're above both of these two key levels that we've already outlined. Let's take a look at the market internals on the NASDAQ. You can see the same amount of relative weakness on Friday. Friday here in the cumulative build is even worse on the NASDAQ side of the market. So a pullback would not be unreasonable to start things things, we're looking to see if buyers want to step up to continue the major trends that we have in place here. Let's take a look at the market profile to finish things up. Look at the mechanical poor high. That's one of the poorest highs I've seen in a very long time out of the NASDAQ on Friday. JKLM periods, 4 flat across the top. Desperately in need of some repair. We have no excess at that high. It's the improper end of the auction. So what's a possibility here? Sweep it to repair it and then come back down underneath. That's what the bears would want to see. If we're on the buy side of the market, as we already know, we're looking for a higher low over that on any sort of weak breaks that repair. If we can find higher low and build value out to the upside, that would be fantastic. Are we getting confluence with our value area low on Friday with any structural levels? Not really. So here's the value area low from Friday. In the NQ, it's much looser. It's not as clean. And instead, I'd be highly attentive to the A period single print. And if we were to break down underneath this level right here at 17,540 opens the door for downside. In my eyes, that's really where the stronger break comes from. And you can argue it would be the same thing as to what we just saw on the daily time frame chart, where here's your 4-day balance. We really do not want to fall underneath that, right? So getting into those A period single prints, that's where really some stronger sell side can come in. As of right now, buyers appear to have the upper hand for all of the reasons we discussed on the hourly. Internals would suggest a pullback, but nothing to the point where we're looking for an outright collapse on something like the weekly or even monthly. And last but not least for the broad market is IWM Russell 2000, the small caps on a monthly time frame chart. One of these things is not like the other. It's the first red monthly bar that we've had to deal with. So automatically, because the close is underneath the opening print, giving us a red-bodied bar, sellers do have the upper hand, but notice the lower wick is starting to push back. Buyers are trying to step up. And the reason that this is important is because if we think about location here, it's really not all that bearish. This is actually a bullish 3-bar play setting up for the potential break of the monthly balance range, which as we know is something that looks like this. On the bar over bar count, we certainly have ourselves a higher low, but also a lower high. So this is pause. This is consolidation. This is a potential weekly higher low, as we'll see in just a moment. We've already known that we've gone wall to wall. Bottom straight to the top. A little bit of a pullback would certainly be reasonable here. And notice that we're holding the midpoint of the range, which is also loosely the monthly 50 SMA in blue. If I just take out the Fibonacci here, we're not going to have the same comparisons to draw as the S&P and the NASDAQ. But notice on this range, we've held the 38.2 in that lower wick. Once again, the lower wick is important. Sure, structurally, there's a little bit more bearish activity, but the lower wick is at an important location, the 38.2, from that point of view on the overall balance. If we auto zoom this and just come in from the all-time high to the low of the move back over here, notice that we've closed right on the 38.2. Ideally, we start getting more price acceptance above the 38.2 to firmly push for that rotation back up towards the highs. A range double is the measured move, so instead of using the Fibonacci projections looking for that, we'll just assume that it's sort of up here in line with the previous highs, and to give you the number, that's 233. So a range double is the measured move target on this particular monthly pattern. And just to check in, let's come in from the low of the sickness up to here. We're still above the 61.8. We never really dipped a toe underneath in any of these pullback instances, so not the end of the world there. As a matter of fact, the low of this bar is actually a recapture of your 38.2. I didn't even notice that prior, but another small, not major, but small bullish data point supporting that we are still constructive for a break of this range in the upward direction, not a massive collapse here. So we'll change our tone if we reapproach the bottom end of the range, as this would be a failed move at that point, but one step at a time so far, there is some evidence buyers are stepping up where it actually matters. Let's take a look at the weekly time frame chart, and as we know, if we're counting weekly trend lows, there was no higher low. We went right to the top of the range. This hammer candle off the weekly 200 SMA was incredibly interesting, and on the daily chart, we know that we're looking for an inverted head and shoulders here to confirm daily trend reversal, equal high, and then possible breakout of the monthly balance range. So that's how the time frames really interact here on the IWM. This is a great example. This is almost a textbook example of multi-time frame analysis. So far, if this can hold as a weekly high or low, we're still good. The unfortunate part about the weekly chart here is that we did close also a red weekly bar, indecisive doji, upper wick is larger than the candle body, lower wick is larger than the candle body. So not much progress made here. Incremental higher high, but also a lower low. The one good thing is that we didn't really close back down underneath the body of the green hammer off of the weekly 200 SMA. So still somewhat constructive constructive on the pattern, but losing confidence. What we want to avoid is this turning into a lower high. Then all of a sudden that starts to feel like, right, this is a failed breakout. This is a lower high. If we reattempt the low of the hammer, it's game over, right? That turns into a lower high double top on the weekly. Then we look for lower back down towards the bottom end of the range, noting that this is a failed breakout. So this is really important stuff here in small caps, because as we know, if this is going to help broaden the nature of the market rally, we really need some participation here in the upward direction, the breakout of this as a monthly balance. So highly attentive to how this resolves here on the weekly. I do want to show you our weekly anchored VWAPs just to support the idea that the monthly higher low, weekly higher low, to me is a strong thesis, noting that based on volume, based on the average prices, right, we're above the band of anchored VWAPs, where in the past, you'll notice we really struggled. We chopped through it, we came right back down underneath. So if this can truly hold as a weekly higher low, to me, that is constructive, and then it's just a matter of time before we find that daily trend reversal back in the upward direction. Speaking of the daily, let's just go there now, and to do that, let's use this little hack, and we'll go over to the IWM, fantastic, and let's take a look, right? So on the daily chart, the largest thing that we're sort of wanting to happen, if you're bullish on the market, right, if you're a bear, you're like, no, bring on the lower high, right? But if you're a bull, you want this to maintain itself as an inverted head and shoulders. You really want that daily higher low on the gap fill reversal, on the daily 50 SMA holding, and so far it did hold. I will give the buyers some credit for holding on to this low. On the heels of the Wednesday breakdown, I was of the assumption that this was going to be like good night, right? We have overhead supply now weighing on price to the downside. Thursday was a decent recovery. Notice on Friday it's an inside bar, so we have to hold our breath here a little bit early on into this upcoming week. But if we cannot firmly get closes up and over 194.10, I think that this is going to pressure price lower, and the equal low here is the concern we just expressed on the weekly chart for this to turn into your lower high double top, break the neckline, and you can kiss this goodbye underneath 187.75. Let's not firstly, we've already kicked things off here, but let's also discuss the expected move. It is above 187.75. 189.63 is the lower bound, suggesting a lower low, unfortunately. Sure, it's a higher low from here to here, but if we're talking about this as a balance, not really great. We're not suggesting an equal low down here at 191.25. You'll also notice that the upper edge is just an equal high, not suggesting a higher high for some sort of breakout. So much more neutral on the IWM for this reasoning here. And the threat, as we'll continue to express, is that this weighs on price as overhead supply, rejecting the weekly higher low thesis and thus the broadening nature of the market rally. That would be concerning. Let's move on down to the hourly time frame chart and get a little bit more granular. Something that I thought was interesting on Thursday again was the strong close up and over this level, and you can see that it actually acted as resistance on that Friday session. So while the broad market, at least S&P and NASDAQ, which is not so broad anymore, it's really concentrated, but as, quote, the broad market was rallying, notice that the IWM actually struggled up against that level, and it really balanced and chopped around before that end of day push. And even into the end of day, it gave back some of that gain. So really, really watching this 194.10 as a key level here on the hourly. Price acceptance above, it's a good first step, but as we've already described, this level needs to be recaptured. Like for this sequence to play out in full, it's all about 196.50. Remember, we had a gap up over the level, no higher low, no higher low, no love, no love. Finally started to get love ahead of that FOMC from Jerome Powell, and then it's all been taken back, right? So you got to recapture that if something stronger is going to happen in small caps, and if they're going to help broaden the nature of the market rally. That's the main gist of what we can see on this screen. Any price acceptance underneath 194.10, I think things get pretty shaky to the downside. You could look for equal low breakdowns. If you're trying to trade this and not just use it as a broad market indication, it would be underneath 191.25, the low of the FOMC day. Let's go ahead and move along to our market internals for the Russell, and you can see the same concepts. Really strong outflows on the FOMC, no inflows on Friday, moving from trend lower zone, slightly higher, but still negative on the day. Cumulative tick is completely flat on Friday. A little bit of a build higher on Thursday, but remember, that's where the broad market was also moved broad. Again, S&P and NASDAQ were really ripping to the upside. They had stronger builds. Notice we dipped a toe negative here on the Thursday morning session for the Russell side. So still not overly convinced that we're going to get this perfect unfolding of the multi-time frame analysis that we've been discussing so far here in small caps. Here are the market profiles for the Russell futures. And what you'll notice here is the double distribution from Wednesday. Here's Wednesday. Here's the meat of the profile ahead of the large breakdown into the close. And what do you see, right? This constant rejection on Thursday's high, Friday's high at 1985 in the Russell futures. That is going to continue to put pressure in the downward direction on small caps, which, as we've thoroughly discussed by now, is not healthy for the broad market. Let's continue to get granular here by evaluating the weekly performance of our S&P sectors. What you'll notice is that the XLY led the pack, consumer discretionary up 3.08% thanks to Amazon earnings. Underneath is the XLC Communications up 2.7% thanks to Zuckerberg and the Fantasyland. Also great numbers there on earnings. Then it's industrials up 1.99%, almost 2% there. Couldn't quite squeak out the round number. We'll give them a break. However, all three of these sectors are more risk on in nature, which is incredibly important as the XLK takes a little bit of a breather. The tech sector, the heaviest weight risk on sector, it's cooling off. There's no arguing with that, especially with the Apple earnings gap down, right? It certainly underperformed there, even though it rallied back all day to close the gap overhead. Weekly performance here was not helping the S&P break out to a new all-time high. There would be much larger red flags going off in my head if the market was being led by XLU Utilities, XLP Consumer Staples, if it was being led by the XLE Energy, lightweight sector, XLB Materials, lightweight sector. If those were at the top of the list as the market's breaking to an all-time high, huge red flags. Not the case. XLC confirms that a risk on rotation is underway. Let's check in on these structural charts and just evaluate what's happening from a price action point of view. If the XLY can continue this break of the balance in the upward direction, that sustains the risk on rotation that we're identifying here for the S&P. We would remain constructive on higher low pullbacks for the SPY daily time frame chart. XLC, it's going to be basically a rinse and repeat here. The trend is up. Lower left to upper right is just about all you need to know. You can see the large gap up on Friday, any consolidation up here, or even a daily gap fill reversal. It's got to be bullish. Only concerned with this chart if we fall underneath the Wednesday low at 75.75. Next up, XLI, industrials, 8% of the S&P. If we continue this breakout, fantastic. It's going to help be a tailwind, pushing the market higher. If it pulls back, retest the prior all-time high, then continuation, beautiful higher low retest over the previous breakout point. Even if it falls back into here, certainly we would concede that it's a failed break and then we're just getting consolidation back down in the range. But unless other heavier weight risk on style sectors are underperforming, just the XLI is likely not enough to really cause a dramatic pullback in the SPY by itself, right? XLV healthcare, second heaviest weighted sector by market cap, as we know, D for defensive as well. Beautiful performance on the Friday session, not falling off the face of the earth, but also not leading a majority of the gains to the upside. Beautiful, love to see it. Going forward, want to see it continue to hold 140 as long as that's the case. No issues out of healthcare. XLP has a bullish setup here with a 3-bar play in the upward direction. Thursday, really impressive break over these prior highs. However, is it near an all-time high? Is it suggesting that we're about to take out major weekly pivot highs? Not really. So can it continue in the upward direction as the S&P perhaps pulls back, as the XLK continues to take a breather? The answer is yes. And if this does break out as the S&P is pulling back, it's just going to mean that the pullback in the SPY is not going to be as aggressive, which is exactly what we want for a mild pullback to yield a daily higher low and stay constructive, right? What we don't want is the XLP leading the gains in the SPY as it's breaking to new all-time highs, and it did not do so on the Friday session, inside doji on Friday, right? Next up, SMH. What's going on with semis? Certainly looks like a breakout point to me. This looks like a failed breakdown. If we zoom in even further on that 3-bar range right here, on Wednesday, breakdown from the range, rejected it in the upper wick. Thursday battles back. Now we're at an equal, if not higher high on Friday. This is a thin structure breakdown right back to this equal high. Have to imagine that the S&P continues in the upward direction if we get that early on in the week. So watching 190-120 very closely out of semis here. Even if it pulls back, let's just say that this does develop a daily downtrend. This is a high. This rejects here for a lower high. We break down. Weekly higher low is the name of the game. Now, of course, in the S&P, we can trade that pullback. We can look for that breakdown. We can understand that context, but I would not change my tone on the bullish nature of the broad market until we have larger downtrends firm daily downtrends in force out of the SMH. This is just a drift. It's not enough to say that the bears are building an edge, right? Not at all. XLF, financials, beautiful daily higher low. Look at the Thursday hammer there on the heels of FOMC, finding support right off of the 2 equal lows from the inverted hammer then hammer combo, which led to the break and push to the higher high. I mean, what else do you want to ask for? Any consolidation in this zone is bullish. Build out a balance range, break it to the upside over time. Constructive. If we slip back down into this lower range underneath 38, yeah, we'll let you know and we'll be slightly more concerned. There's an opportunity for maybe a head and shoulders on the larger time frame, but we're not there yet. And so far, this is a constructive daily higher low, so bullish until proven otherwise. XLB Materials, extremely lightweight sector, doing nothing inside of this as an overall range. We're moving on. Next up, utilities. I don't know about you, but it looks like a lower high rejection underneath the double top neckline. boom, rejected on Thursday, even though we had a strong bullish engulfing bar, just an inside bar on Friday. So are we seeing risk off sectors drive the gains in the S&P? The answer is just simply no. The structural charts do not, suggest that by any stretch of the imagination. Here's the XLK, right? Even with Apple's gap down, strong rebound on the Friday session. Unfortunately, it's not enough to change the weekly performance metric, but regardless, this chart does not look bearish. Almost a rinse and repeat of the SMH. Certainly a daily high or low possible here. Remember, we're pulling back from the highest high. We didn't have an hourly downtrend through any of this breakout. So if this is your daily high or low, equal high on the table at 206, blue sky territories overhead, you can't be bearish on the S&P when the market looks like that. You might want to, manage your risk and say, I don't really, feel comfortable buying higher highs, the all-time highs in the market. That's fine, but I wouldn't go out there trying to short the market looking for this huge meltdown when the sectors are just postured in such a bullish nature here. XLE Energy, lighter weight sector, stuck sideways in this, watching to see if we can get round 2 of an inverted head and shoulders. Remember that this failed on the first attempt here with the gap up over the level. Let's see if we can get round number 2, maybe constructive over 85.50. Starting to see some lower wicks buyers stepping up, offering demand at 82.75. Next up, XLRE, real estate, lightweight sector, also very rate sensitive. Even with Jerome Powell saying that, hey, we're not going to cut rates, it has not fallen back down into the majority of the consolidation range from all of 2023. It's just not there. So is this going to be a monthly high or low over the top of that balance? Certainly seems possible. Big lower wick on the Friday session, hammer candle there, closing back inside of Thursday's range. We'll see if it moves higher. It's such a lightweight sector, it's not going to make or break the S&P. The main takeaway here is that we are continuing to see a risk-on rotation, which is bullish for the market, sustaining the uptrend on the daily time frame. Here's the sector ratio grid. If you're not familiar with the screen, check out the video tutorial in the top right-hand corner. The XLK trying to flatten out over an upward sloping still 50 SMA and also over the flat top from back here. It looks good, but I still want to see more. I want to see that curl in the upward direction before your XLY potentially pulls back. Main reason being is that the XLF actually offered a lower high, and now we're basically trading back at the equal lows. So not thrilled by financials. Really want to see this either turn higher and compress into maybe a new ascending triangle, something that builds like this over time. Then we'll look for a breakout that would be risk on and constructive. But I want to see a little bit more here out of tech, especially if the XLY is going to back off or vice versa. This needs to either continue aggressively as this tries to hammer out the bottom and then look for that rotation. And then maybe we pull back off of the descending 50 SMA here in the XLY. So to remain risk on, primarily watching the relationship between these two here into the coming weeks worth of trade. XLC Communications Meta speaks for itself. Huge move in the upward direction. We're not risk off. Look at the XLV rolling over here. That is bullish for the broad market. This rolling over here is bullish for the broad market. Same thing in utilities down below. The risk off sectors are not outperforming on a relative basis, which is basically our conclusion from the structural charts anyways. Let's take a look at some specialized ratios. Here's the XLK over the SHY government-backed short-term bonds. You can see we're outperforming in growth-oriented stocks. That is a bullish risk-on indication. Same thing over here, same concept, but using utilities as a proxy for yield, you can see the higher low that's forming. This is bullish and risk-on by nature. Let's move along to apples. XLY, XLP. A little bit of work to do here. We have not hammered home the higher low, right? Certainly still there. There's an opportunity for it on a monthly or even weekly time frame perspective, but you got to be a little bit more constructive here. It really raises some questions, specifically with that Thursday breakout we saw in the XLP. Why, even with Amazon earnings on Friday, was this unable to perform and get over a descending 50 SMA? Like, why can't we hammer home this higher low a little bit more firmly? This is one of the major sector relationships that I'll be watching into the coming weeks worth of trade to continue to gauge how confident we are in the higher low pullback on the SPY daily chart, right? Next up, let's continue along to our dollar. What's going on with the Dixie? Big breakout on the Friday session, right? Finally, a daily close up and over that 103.50 area. Can we see continuation? And as such, if that's the case, it should act as a headwind for equities. And what you'll notice is this is another divergence. Technically speaking, when the dollar's higher, it's tightening financial conditions. Why was it that the market saw no problem moving in the upward direction, right? It's not always going to be married hand in hand, but it at least raises some concerns about the strength of Friday's breakout, the sustainability of Friday's breakout in equities. Who's lying? That's the question to ask here, right? And we can start looking at things like the metals to maybe gain a little bit of insight. Gold's not really going to be too helpful. It's chopping around, doing not a whole lot inside of this range. I would still argue that on like a weekly or monthly chart, yeah, this is really constructive coiling near the all-time highs and a breakout for a huge cup and handle. We've talked about that in the past, but silver is a little bit more insightful because silver has been leading gold, and obviously we know if gold is going to break down, it would mean a tailwind for the dollar to move higher in theory, putting downward pressure on equities. Look at the lower high. Look at the breakdown on Friday directly into this low set right here. If we snap underneath 2250, I would tend to think it spells a deeper pullback for the market. I shouldn't even say deeper pullback, but just a pullback for the market as the dollar is bolstered in the upward direction. So watching silver closely at 2250 and the dollar in tandem to see what happens early on in the week. Moving over to rates, rates also moved higher. So again, someone is lying here. Generally speaking, these things do not happen where you see a strong break in equities, strong move higher in rates, strong move higher in the dollar. Something's not adding up here. And to me, based on the performance of the market being so concentrated in the Magnificent Seven, I would tend to think that the market could use a little bit of a pullback here to remain constructive. So with rates moving higher, we know in theory that puts downward pressure on tech. We're watching out for that. Let's take a look at the inverted ZT to get a sense for what maybe the Fed is going to start thinking about. We know that the Fed's been very transparent based on Jerome Powell's commentary in the latest FOMC that they're likely not going to cut rates, not hike, cut rates in the March timeframe. And the 2-year saying, yeah, we agree with that. Any sort of breakout in here to me would start to if we trade in this zone, if we start trading over the 102 handle here in the inverted ZT, that is where I would say, all right, maybe even the May timeframe meeting may be in question in terms of cut versus no cut. So watching that here, it looks to like, if you're just looking at this from a technical point of view, looks like an inverted head and shoulders, looks like it wants to go higher here. And again, like maybe that rate cut in May is off the table. So let's do what we do best and move over to the tracker tool. So still priced into perfection, expecting 6 cuts in 2024. And I don't know what the market's seeing that I'm not seeing, but based on the labor report, based on all the data that we've been getting, doesn't seem likely that 6 are in the chamber. The one thing that we do want to watch is the 2-year and what that might suggest, as we were just talking about the inverted head and shoulders neckline. Do the probabilities start shifting over here to the 6.2 side, or do they actually start increasing here for the 50 basis point rate cut for the first go around in potentially May? We know right now that it's almost off the table for a March cut. We're somewhere around 62% odds of a pause versus 38% odds of a cut. So we're going to continue to monitor that. But so far, I think the May meeting is the next big one in question. Unless something dramatic happens in the labor market, we're not expecting much of a change here. Speaking of the labor market, let's look at the data from last week. Firstly, let's acknowledge, because this is important, let's acknowledge that the initial claims missed. 224,000 versus 313 as the expectation. However, we're not over the threshold of 250 where we say, okay, some larger issues may start to appear in the month-over-month data. So far, so good, but we're starting to miss. Notice a couple of misses in a row now, 1 and 2 happening here. The orange is the expectation. The blue, of course, is what the actual reading was. So not great, some small early cracks, but still underneath 250. So with that caveat, let's look at the monthly data. The monthly data, the biggest concern is here with the hourly earnings really heating up on a month-over-month read, 0.6. That is a potential threat to reigniting round 2 of inflation. So it makes total sense that Powell would not cut rates in the March timeframe if this is what's happening with real wages. Because remember, real wages increase when hourly earnings increase, but inflation is also falling, right? You're outpacing the rate of inflation with your actual earnings. And people are getting jobs. You can see here the blowout number on the NFP, 353 versus 187,000 is the expectation. And what about this one? The revision to the prior from 216, I believe, 216,000, 216,000 to 333,000 jobs added in the previous read that were unaccounted for. So what about all the folks who say, oh, the numbers are cooked, they always revise them down? What about the revision to the upside, right? The unemployment rate remains historically low, 3.7%, the lowest in like 40 years. Consumer sentiment continues to move in the right direction. The revision is slightly higher by 1/10 of a point there. And you can see inflation expectations remain anchored at roughly 2.9%, moving in the right direction. Expectations almost drive inflation itself. So all of this really, to me, aligns with the idea that the soft landing can still be achieved as long as we don't get a round 2 of inflation. So taking that March cut off the table makes a lot of sense to me based on the data. And if we take a look at some additional data, you can see that this historically, just to frame some context around the hourly earnings, this is somewhat of a contributing factor to the runaway inflation that we were sort of experiencing, right? You can see wages dramatically increasing versus what we had as as a prior, which is underneath 0.5. 0.5 is the hidden number over here, right? So we want to see that come down. We want people making real wage gains because that is productive for the economy. They can spend more, right? But we don't want it leading to inflation. So ideally next month, this comes in at a lower reading. And then here we go with just some historic reads to illustrate the revision in the upward direction. It's the largest one that we've seen in a very long time. Revision to the NFP, jobs added in the December report, right? This is the current read, certainly over the prior, even after the revision. So overall, labor market remains robust. We just don't want to see a second wave of inflation. We don't want to break the labor market, but we don't want wave 2 inflation. So I think that a pause here from Powell makes a whole lot of sense for the March timeframe, and then we'll reassess as we go into May. My belief for the market, just to level set with you guys, is like maybe 2 or 3 really well-placed 25 basis point cuts in 2024 makes the most sense to me. It would almost mirror what happened in the mid-90s when rates were cut slightly because inflation actually fell to target, right? So you can go back and you can study the mid-90s if you want a historical example. Let's take a look at the earnings, because all of this at the end of the day comes back to the valuation of the S&P. You can see the increased blended earnings this week due to multiple sectors, not just concentration in the XLK, the XLY, the XLC. You can see the healthcare improved. It's still not positive. Like, let's not get this twisted, but it did improve here. It's getting better. Same thing with the energy sector. Not good numbers. Like, let's again not get this twisted. Not great numbers, but improvements are being made. Financials also improved down here. That's something that we are going to watch quite closely. And you can see this improvement in the expectations over here. So this is Q4 2023 earnings growth rate. We wanted to see earnings tick in the upward direction because if there is going to be a PE contraction, let's bring this full circle, shall we? If there's going to be a PE contraction because the Fed is not going to cut rates 6 times, the only thing that can counterbalance a PE contraction, which is the opposite of what we've already seen, multiple expansion was the main reason for the rally off the October lows. If we're going to get that, then you need earnings to play catch up. And so far, this is a good first step. Last week in the video, we said, hey, we need to see Microsoft, we need to see Amazon, Meta, all these heavy hitters, the Magnificent Seven, they need to bring home the cheddar. That's word for word what I said, and they need to do it promptly. This is exactly what we were looking for to continue to justify the higher prices in the S&P. Is it still too high? Perhaps, based on some valuation metrics. However, to step in the right direction to justify instead of the wrong direction. If earnings were a huge miss this week, oh boy, S&P would have been in a world of hurt. This upcoming week, what do we have on the calendar? Some main top watches would just be your Caterpillar, Palantir. Remember that Starbucks technically has a larger market cap than Palantir. So as much as you might love the AI story of PLTR, Starbucks, let me just go order up a couple of venti lattes or whatever, and no issue with Palantir. As we move into the bulk of the week, you're getting some smaller cap tech stuff, Snapchat, PayPal, ARM from a chip making perspective, right? Some honorable mentions here. Cloudflare might be an interesting one, but nothing as market moving as what we've already experienced. I would start watching out for the next wave of consumer staples that start to come out, not this week, but the week after that. What about the risk appetite of the market as we're making those new all-time highs? Flight to safety is absolutely not underway via the TLT ratio to the S&P. If the TLT were to break down, though, underneath this pivot low, it would start to raise some concerns like why is the bond market selling off so aggressively? What are they seeing that maybe we don't see here? And if we take a look at bonds in relationship to themselves, this continues to suggest that I don't think it's going to get nasty there. We'll keep it, we'll keep a very open mind to the possibility of it happening. But right now, these ticking higher, specifically on Friday when rates really took off to the upside, would suggest to me that people are trying to get involved in short duration assets at higher rates one last time before maybe it is May for that rate cut. And there's that next announcement, and we know it's the nail in the coffin. So still maintaining that thesis, primarily backed by credit spreads here, not suggesting that a credit event is underway. Here's the SVB breakdown, just highlighted in red, and you can see that we're not even close, right? With the New York Community Bank Corp going down on Wednesday, we're still in a downtrend here. We're consolidating sideways. There was no huge uptick, a little bit of a blip, but nothing major, even comparable to what we had during SVB, right? So all good on the credit spread front. Let's take a look at the HYG in isolation, see what's going on from this point of view. A little bit of a divergence. This supports the idea, which is the whole thesis of today's video, that a pullback may be likely in the S&P. negative divergence, higher high, lower high in the HYG. Bonds are sniffing something out in the immediate time frame. Let's take a look at Bitcoin. What's going on with the digital gold over here? Still stuck sideways in the range. Not much to comment on for that. What about breadth? Market breadth was a large issue this week. Really, slightly lower. It's still positive. And remember, we don't need blockbuster reads to kick off a rally. We've talked about this a number of times. When you relate these two things, we're all good, right? Just to pair them up beautifully. There you go. You can see that you don't need really strong reads, but you can't go negative. So this tick in the downward direction is not detrimental, but it doesn't give me a fuzzy feeling inside as we're making a new all-time high with breadth actually divergent to that. If we take a look at the SPX A200R, flat on the week, nothing to really comment on there. The SPX A50R is a little bit more insightful, breaking down on that Friday session, continuing to the downside even after this pullback started to rebound on Thursday and Friday. So overall, the breadth starts to become more of an issue when you read into the SPX A50R. And again, this is not like end of the world, sell everything, we're underneath 50%, but it's not adding up that the breakout on Friday was really all that strong. And we can continue along with this idea. Taking a look at the RSP, you can see that we certainly moved sideways, but we did not break for a higher high. And again, the S&P the weighted down below, did find a more meaningful higher high, new all-time high, not supported by the equal weight RSP up above. The QQQE is in much more lockstep with the NASDAQ weighted down below, but it didn't make an equal high. The QQQ did, as we just saw on the daily chart, and we're skeptical of that equal high breakout. This would be a supporting piece of evidence for that exact reason. You can see the lower highs into the end of last week. Last but not least, for our breadth is going to be the Dow Jones, and you can see that we just chug away to a new all-time high in industrials, and transports are still like, hey, we're still underneath our double top, right? So overall, this is still telling us to be cautious. It's been that way for quite some time. It's not a full-blown like short signal. And obviously, if you've shorted the market, the S&P that is, based on this being divergent, you've been run over like 1,000 times. So that is not reliable, but it is a back pocket supporting context piece for saying, hey, breadth really isn't that great across many of the different factors that we watch. It's not enough to short the market, but yeah, skeptical of higher highs, maybe. Here's the VIX, certainly suppressed on Friday with the move to the upside. You would have expected a little bit more VIX crush on Friday, and that was not the case. So this is another red flag, like, okay, why is this holding sideways instead of moving lower when the market was aggressively higher? I think it speaks to concentration risk that the market can clearly see. Like, I don't claim to be a genius for being the only one who can see this. That is for sure. Here's the VVIX, volatility, a little bit lower, but not suppressed directly into 75. Again, with the magnitude of Friday's breakout, would have expected a little bit lower. At least a new two-day low did not take place here in the VVIX. So the market's kind of on edge a little bit here, skeptical of the break that we saw to the upside, that new all-time high in the S&Ps, not on board all the way. Here is the volatility futures, and you can see we're underneath that zero line, strong contango, no issues with this one. Same thing, 9 versus 30-day, one-day VIX, right on the cusp, right on the threshold here. We're still building data on whether or not this is relevant. So far, it just seems like it opens low every day, rallies high. And, there's some times where maybe it gets really elevated here, but nothing concrete to really take away. Let's take a look at skew, because skew ripped to the upside, and this, again, is a huge indication of people being skeptical of the upside. Remember, it doesn't always mean that they're going to be right. This is people saying, no, we don't trust it. It doesn't mean that the market needs to collapse. Generally speaking, the consensus view is not what happens, right? Other than like, hey, markets tend to go up over time. That's not what we're talking about here. We're talking about immediate term, forecasting. This is everybody betting on a pullback, right? We don't trust this market rally. So we'll see, but the stronger skew indications actually come from the lows. We've talked about this repeatedly. It's not really an issue right now. Just understand that people are very, very skeptical of these higher highs. So what does that mean? If, number one, if this is going to be a leading indicator that people are going to start shorting these all-time highs, short squeeze is going to continue to propel that. So I would watch this skew quite closely, actually. If this can start ticking in the downward direction, to me, it's actually a healthier indication that, yeah, the market can pull back as people start throwing in the towel and not shorting the all-time high. Like, let the natural pullback unfold. Don't try to jam the short into the market itself. If you've made it to this point in today's show, it is a monthly recap. It tends to get a little bit long. I appreciate you sticking it out to the core list of companies. Do me a favor, you probably already have, but if you haven't, thumbs up button, subscribe. It goes a long way to support the channel. With that said, Apple's up first on the core list of companies. You can see the large gap down on Friday was faded in its entirety, and we closed inside of the two-day range from the Wednesday and Thursday session, producing now 3 equal highs straight across the top at 187.50. There's the possibility for some short squeeze here to continue in the upward direction towards 190.85. When I say short squeeze, we're not talking about on Monday, first hourly bar making a new all-time high. We're talking about added buying pressure from shorts who have terrible location trying to short in the hole from the gap down on Friday, shorts who are still involved from the two-day balance on Wednesday and Thursday. If they close out over the equal highs, added buying pressure, then looking for a stronger lower high to be produced. The three equal highs would suggest that cleaning that structure up could yield a stronger lower high. Now you're dealing with highs, lower highs, lower highs, all of these equal lows. The door is open for a breakdown. And then you have to start thinking about, okay, monthly context, double top, weekly context even, right? The buyers, if they're going to have something stronger going on here, need a hold over that 187.50 because of what it represents from this point of view as a daily short-term double bottom. There was absolutely zero attempt here to hold over it on the pullback retest, and obviously earnings were this nail in the coffin. With the equal lows, the trend is jeopardized. So at best, we start to flip back to neutral. If we get acceptance over 187.50, if there's a rejection back down underneath, sellers have the upper hand here out of Apple. Next up, let's take a look at Microsoft. Daily time frame charts, a little bit confusing because you might look and say, oh, big bearish engulfer on Wednesday. Why are we higher? Let's take a look at what actually happened from an hourly perspective. Here's the momentum on the, sort of earnings debacle, if you will, in the FOMC. Do the sellers have any momentum, like true strong momentum? The answer has to be no. Look at Thursday's open, technically underneath this area. If this is going to all act as overhead supply, if all the buyers up here are like, hey, let's throw in the towel, it's been a good ride, we made new all-time highs, let's just get out of this thing, you would have seen a lower high here on the hourly. Not the case. We poke up through the entirety of the range, and then Friday speaks for itself, breaking out to the now three equal highs. So the only thing you should be thinking in Microsoft is, how can I participate in the upside on higher low pullbacks over 405.50, or if we get a three equal high breakout over 412.50, where's the retest higher low for continuation into blue sky territories? The sellers only have something going on if they can make something stick underneath 402.75. So that's Microsoft. Next up, Google. We're staying on the hourly time frame chart just to explore a little bit of the squeeze possibility up and over 142.15. You can see intraday the rejection there on the Thursday session. If there was going to be a squeeze, generally speaking, it wants to happen the first go around. So we'll keep an open mind, and there's still an overhead gap that needs some filling. I shouldn't say needs, but can potentially fill over 144. So any good first looks basically are consolidation up here early on in the week, and then we'll watch for the gap to close overhead. If we just reject this after a lower low, really doesn't strike me as anything more than just a lower high here, and continuing to be bearish on Google for that reason. If we take a look at the daily chart, it would have been nice. Let's just put it this way. It would have been nice if this were a cleaner hold. We'll be somewhat okay to say, like, okay, maybe there's like a weekly or monthly higher low. You get lows, higher lows, higher lows, higher lows, perhaps. But the breakdown on Friday was a little bit more aggressive than what we'd like to see, especially after already an earnings debacle gap down. So we're somewhat open-minded to a recovery effort here out of Google, or at least I am, for the gap to close overhead, but it's just not as clean as it could have possibly been. So mainly watching the gap. 144 closes up to 151.15. Next up is Amazon. Big gap up. Just take this for what it is. Any consolidation up here has to be bullish. If you start breaking underneath 169.25, it's a first step that maybe the gap is going to close underneath, but there's such a range here that you don't need to be the first one in the door. Here it is on the hourly time frame chart, right? Notice the large lower wick. Buyers stepped up. So if we start to slip it with price acceptance, great. Look for the hourly downtrend with a lower high underneath 167.35. If we're going to break in the upward direction, there is a nice flat top on the hourly, where if we can break higher low and stay above 172.35, looking for upside, we want to do this. The next major level is closer to 179.50. And this is because, let's not forget about Amazon on the, let's go weekly, let's go multi-year daily time frame chart, right? Just to remember that this is when volatility, VIX at least, was well over 2050. Now VIX is underneath 15. Right? So we're in two different environments. Of course, the levels, the ranges up here are going to be much larger. It's going to feel like, wow, there's miles to run in the upward direction. There's got to be something, right? Unless there's something intraday that forms, the structure off to our left is actually not suggestive of any major resistance until we hit that level, 179.50, all right? So next up is NVIDIA, new all-time highs, big breakout on Friday. Is it possible for a pullback, a retest, close the gap, then look for upside? Absolutely. Earnings are further out on this one. Not as much of a concern. Here it is. You can certainly see that thin structure starts to retrace underneath 659.50. So if you're aiming for a pullback, make sure you're underneath 659.50. If you're just consolidating up here, I would not try to short a new all-time high out of NVIDIA. That has not gone well for anybody ever since the major announcement of AI and how they're contributing from a chip making perspective. So NVIDIA, blue sky territories. If there's a pullback, I would really prefer to participate in pullback, higher lows instead of trying to short for the duration of the pullback. We'll take it in stride when it happens, but that's the main look out of something like your NVIDIA metaverse. New all-time highs, very similar to Amazon. However, instead of having an overhead level, there's just nothing. So if we start to slip underneath 473.50, maybe we test the open, maybe we look for the gap underneath, but don't be the first one in the door. Wait for a solid trend and a way to manage risk underneath. Any sort of consolidation up here has to strike me as bullish, looking for blue sky territories if we're just holding sideways. Next up, Tesla, fall from grace, really ugly. Let's go to a daily chart here. Trying to get in gear, but it just can't, right? You can see multiple attempts, the upper wick, I should say, of this bar, the lower wick of the Thursday session. Friday tries to form a hammer as well. So we'll see early on, but this is just nothing more than a sideways daily balance range. It's not doing anything constructive. On the hourly chart, you might be a little bit more thrilled to say, like, okay, maybe double bottom here, but what's the caveat, right? You need to be over the neckline for that to technically trigger at 192.92. Prior high from the gap down, prior high in rejection, tried to hold it here, found resistance underneath on the Tuesday session, right? So it doesn't really have a good track record of wanting to resolve 192.92 higher. So what does that mean, right? The takeaway would just be I would wait for the higher low. I would not take the break of this level, and instead I would try to operate around the higher low, aiming to close the gap overhead. Maybe there's an oversold rebound out of Tesla, but it looks fairly bleak. It doesn't really look like buyers are stepping in here. People are talking about it all the time. Like, just the sentiment around Tesla is, no, it's fallen from grace. It's out of the Magnificent Seven. People are writing it off. So, take that into some consideration as you're attempting to figure out an entry there, perhaps on the long side. Here is Netflix. We're still on the daily time frame chart here. Decent looking consolidation, however, starting to slow down a little bit. It's really not like on the hourly chart. We've talked about this in the pre-market streams. There's nothing happening here. Like, Netflix is such a back burner ever since earnings. This is the concern. Like, let's bring it full circle, right? If the earnings from Amazon, if the earnings from Meta, if the earnings from even Microsoft, like, things start to like slow down here as they're doing in Netflix, that certainly leads to an S&P that could stagnate. And unless you're seeing rotation into, again, industrials would make sense. Financials is a big player, right? We really want to see financials start to play catch up. Unless you're seeing that rotation, it would be very reasonable for the S&P to sort of stagnate here and go sideways. Not necessarily lower unless these gaps aggressively start closing to the downside, but stagnation or some sort of mild pullback while that's taking place without the rotation into financials makes a lot of sense if Netflix is going to be the blueprint, so to speak, for what we can expect after a big earnings report, right? So just take that with a grain of salt. Let's move along to additional ideas. We're on the home stretch. 2 ideas and you're on your way. Snowflake is up first, and keep in mind we are starting on a weekly time frame chart just to illustrate the long-standing base that's already been built. The flat top did break out last week, and of course we did have higher lows the entire way, forming an ascending triangle. So if this is a breakout, it's very possible that we go to the next weekly area of resistance. Prior support offered a weekly lower high around 240. That's the weekly analysis. Let's take it on down to a daily time frame chart. Notice that earnings are a little bit further out on this one, not a concern for the coming week's worth of trade. Strong breakout on the Friday session, up and over a flat top here at 209.85. So a couple of ways to get involved. Either looking for straight up continuation on consolidation over 216.68. We'll look at the hourly in a second to trade towards 240. Is this going to happen in 5 minutes, 15 minutes, an hour? I wouldn't really hang my hat on that idea, but generally speaking, looking to move in the upward direction. On the hourly time frame chart, pullbacks are also very reasonable into the breakout level at 209.85. If we slip underneath 216.68, this, and then trying to find buyers and participating with those buyers on the retest of 209.85. So Snowflake, top name to watch based on a weekly pattern and how that might trickle down here all the way to an hourly. Next up, let's go back to a weekly because I've got another big one for you. MDB, Mongo database for the folks who use it. It's a decent tool. If we can break through this weekly flat top, which as you can see is a multi sort of pattern, right? You've got a head and shoulders from this point of view, inverted, right? You've got a cup and handle from this point of view. You've got a cup and handle within the cup and handle, and you've got an inverted head and shoulders within the inverted head and shoulders. So, huge fractal patterns taking place on MongoDB. We're not talking about this happening in the blink of an eye. Keep in mind, this is a weekly time frame chart. The measured move would be from the head of the major pattern to the neckline. If you can clear that, you can easily see how that's suggesting a new all-time high. So back pocket with the major situation here on the weekly time frame. Let's go on down to a daily just to understand this a little bit further. Here's your daily balance, right? And you can see on Friday we broke out over a flat top. 1, 2, 3 on the daily time frame, 423.25. So just like Snowflake, a couple of ways to participate. You can either look for the clearance of these equal highs here at 437, continuing into the 450 weekly level that we need to clear for the larger pattern to be enforced, or if we get an hourly pullback off of these equal highs, finding a higher low over 423.25, let's go to the hourly chart now, speaking of, you can start to make the argument that this is constructive to continue in the upward direction, just like Snowflake on that pullback, looking to participate if we can find buyers on the retest of 423.25. So those are two bullish patterns for you. The weekly charts look very constructive based on long-standing bases. This is not just like trying to buy all-time highs, continuation. These are strong patterns on higher time frames. So keep in mind, you need to manage expectations. If you're looking at a weekly chart, remember, time frame of analysis must match time frame of execution. Manage those expectations. That's all I've got for you during today's episode of the Weekly Watchlist. If you made it all the way to the end, again, huge thanks to you. It's been a great time seeing the recovery arc after getting over the sickness. It's been a great time hanging out up in the penthouse suites. So thank you truly from the bottom of my heart. With that said, we'll see you on Monday for the pre-market prep live at 8:15 as always. And with that said, have a green trading week.